Oh boy, another concept pulled out of thin air. Yep, I know, that's my bad. Anyway, we're going over defended swings today, as you've seen from the title and the thumbnail. Defended swings are, it's in the name, they're literally defended. I'm going to let that sink in. Because yes, swings can be defended. And I know you're like, don't swings have liquidity at them and price seeks liquidity constantly? That's true. That's 100% true. Probably 200%. But yes, that is true. The reason certain swings can be defended is because sometimes price will build up orders at that swing. Probably like, what? Yeah, you've seen consolidations before. You've seen accumulations constantly. I know you have. Price, the first form of a defended swing, okay, is when price accumulates or has heavy price action, or once again, lots of price action around a swing or in proximity to it. What I mean by in proximity is right before and or right after the swing's creation. Okay, so something like this example I marked over here. You see, I'm not going to go into it right now because I want to explain both forms. But you see how this swing right here has a lot of accumulation before it and a lot of accumulation after it. It doesn't have to be both before and after it. It can just be before. That's perfectly fine. And then it can just be after it. But if we see it before and after, that makes the swing even more defended. Okay, but that's just the first form. Whenever we see this around a swing's creation, that causes the actual swing to be defended. And as you can see, every time price tries to visit and or break the swing, it fails to do so. It drops here, delivers higher. Drops again, fails to do it, shoots higher. And then eventually it does come back down and hit it. And I'm going to teach you when price can hit the swing, when the swing is actually vulnerable and the algorithms are like, okay, let's finally take out this level of liquidity. I'm going to teach you that. The second form of a defended swing is when price accumulates before a break in market structure. Very simple, isn't it? Very, very simple. There's a little bit more details, a little bit more critical details to go over with the second form, but it's that simple. So let's first go over, form one, this example right here. I already explained it, so you already know that this is a large accumulation of orders before and after the swing's creation. So that causes this swing to be defended. The point gets proven because price comes down, tries to break the swing, fails to do so. Now, when can this swing get taken out? When can price come below this swing and say, okay, we can take out this level? Whenever price distributes or expands away from the swing. That being this right here. Jumps away, retraces, and then gaps up. This entire move here is distribution or an expansion away from the swing. Does it expand? I'm going to ask you, does it expand? Does it? It does. It does. It does expand. If you said yes, yeah, it does expand. So this swing right after this delivery higher, if you want to see how large the delivery was, it was 255 points. So that's a pretty good expansion, wasn't it? So this swing is now vulnerable. Price can hit this swing whenever it likes to. Okay, but if we look, the narrative is not to drop right now. Price just doesn't want to do it right now. It looks like we have some sort of power of three situation going on. We got accumulation right here. We got that manipulation, then that distribution. I think that's what happens here. But the second time price tries to hit the defended swing, it fails because the current narrative is to not hit the swing. It's the current narrative is to jump higher or to manipulate in this case, since this is a power of three example. So this is the real expansion away from the swing right here. This is the real one because I don't think I have to explain. Over 500 points of expansion. Yeah, this is obviously distribution away. So this swing is extremely vulnerable because the accumulation of orders in proximity of the swing has been distributed. That's what this first expansion was, and then this second 500 point expansion was. All it was doing is just distributing all the accumulated orders here. So price can hit this swing, right? It can do it smoothly. Does it do it? Well, after the manipulation of the power of three, it reverses, creates like a little rainbow around here, goes up, and then comes right back down, crashing over 1,000 points past that swing, causing this swing to become sell-side liquidity. Whoa, interesting, isn't it? Very interesting. Then we have another example here, another first form of a defended swing. You see, before and after it, like I said, it's not required to have a large accumulation or a heavy amount of price action before and after. It can just be before. But in this case, we have it before and after. Price is consolidating for about, what is this, 3 hours? I think 3 hours of a consolidation. The swing is created. It proceeds to not necessarily consolidate, but move very slowly, in which I would still consider a consolidation. So this causes this swing to be defended. As you can see here, price tries to break it, fails to do so. Distributes higher, causing all the accumulated orders here to be, what's the word? Is it expended or something like that? But yeah, all these orders here are basically exhausted. They've been delivered from this expansion and or distribution higher. So price can now take out this swing, right? Because this is sell-side liquidity. There's sell-side liquidity not before, but below this swing. And I'm not editing that out. If we look, price comes down, tries to break the swing, fails the first time, but it does retrace. I think it retraces to some lower time frame PD right around here. I think there's like a fair value gap within this area on the 15-minute. But it retraces to it, and then it finally comes down, breaking the swing, offering a liquidity purge. Reason being, if we look what happened right afterwards, boom, just complete delivery higher. So these are both forms of defended swing. The first form, of course, this low, and then that low here. This is both the first form of a defended swing. Next is the second form. I'm only going to go over one example of this because I do not want to make this video 20 minutes long. Here we are with the second example. This is the break and market structure right here below this low. And as you can clearly see, without me saying anything, the accumulation before it. This is about, let's see, how many hours? 16 hours worth of consolidation. Whoa, look at that. About 17 if you want to round it up. So 17 hours worth of heavy accumulation before the break and market structure, okay? Price comes up, purges the high here. That's that run on buy side before we create that that break and market structure, or that shift in market structure, as some say. Price tries to come up here, hit the defended swing, fails to do so. After it creates the break and market structure. Are you listening? Are you listening? Creates a break and market structure. Since there's such accumulation before the break and market structure, this becomes a defended swing. This right here. This becomes defended buy-side liquidity, if you want to say. So this becomes defended buy-side liquidity. I need to make that gray, but it doesn't really matter. Tries to come up, purge that buy-side liquidity, fails to do so. And if you want to use external confluences, there's a 15-minute order block, like in this candle. If I jump to the 15-minute now, you'll see it. But it hits that order block and immediately drops lower once 10 o'clock hits the London close. If London close kicks in, literally gaps lower and just keeps dropping, dropping, and dropping. Now, can price hit this swing? Based off of this expansion away, this right here, can price hit the swing? Yes or no? Can it hit this? Can it hit this swing up there? Yeah? You say yeah? Okay, let's see. It does indeed hit the swing. You were right. Price delivers higher, aggressively past the swing. Pretty nice, isn't it? Very, very simple concept, but it's very, very critical if you know it. Because it can tell you where price is truly headed. And even if, like, for example, if the narrative, well, your narrative, let's say your narrative on this day, right, is bullish. But you're like, okay, we're seeing lower prices, and I understand that price is pushing away from this defended buy-side liquidity. So we're like, okay, we can see that manipulation away from this accumulation, which is, power of 3, accumulation, manipulation, distribution. So you're like, okay, our narrative is bullish overall, but we can expect that manipulation since this swing is defended. It manipulates, and you're like, okay, let's get ready to, enter buys. You enter at this fair value gap or some, I don't know, however you want to enter or however you prefer to enter on the 1 minute, 3 minute, 5 minute, doesn't matter. You enter for the longs after the manipulation has been offered from the, defenseless or the once defended swing, or the once defended swing up here before the, break and market structure. After that manipulation lower or that distribution from the accumulated orders before it, that swing is now defenseless. So now it's no longer defended. So you're like, okay, let's start buying. Buy, 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 buy. Your target is that swing. Boom, you made some cash. Yeah, pretty simple, isn't it? A very, very short video. 10 minutes at that. But yeah, I don't want to make it any longer than, 10 minutes, 40 seconds. So let's stop the yapping. I hope I taught you well when it comes to defended swings. I hope you can use it against these algorithms, Goldman Sachs, all of them, Berkshire Hathaway, all of them, the major banks, all of them, private equity, doesn't matter. Whoever you're going against in these markets, I hope it can help you. Anyway, enough of me yapping. I'll see you guys in the next teaching. Good luck and good trading.